October 4th, 2023. Today we got a leg one, leg two measured move from the low of 12 up to the high of 37. And then you put that on the low of 59, and that's exactly where we touched. So we got a strong leg, pullback, and then a second leg up. The reason we got a second leg, the way to think about it is this is all a breakout. This is a tight bull channel, and it's a breakout on a higher time frame. So let's look at a 30-minute chart to visualize it better. 30-minute chart, you can see you get a strong breakout from bar 13 to 31, and then you got the pullback, but you know this pullback is probably going to be minor because of how strong this is. So when you get something this strong, you need to be thinking that you're going to get a second leg up on all time frames in general. And so when it happens on the 30-minute, you can be expecting a reasonably good rally into the close on the 5-minute. And so that's why when you get such a tight rally and you start to get a pullback, you have to be really open to the fact that we might get a leg two measured move. I have examples of this, like two-legged moves. So let's look at bull two-legged moves. This is December of last year. You can see we got one leg, pullback, second leg. More clear examples. One leg, smaller pullback, but second leg, still a bull trend day though. One leg, pullback, second leg, that's a good example. But these leg one, leg twos, one leg, pullback, second leg, are extremely common. So anyways, bar one, big bull bar closing near its high. In general, I was more bullish on the day. So if we get follow through, it's probably okay to buy, but you need a really good bull bar. And we did not get very much follow through on bar two. You have to keep in mind there's an 80% chance of at least a minor reversal attempt on the open. So even if bar two closed near its high, it's reasonable to buy, yes, for a scalp, most likely though, because we're probably going to attempt to reverse at least in some fashion. Bar three, bear bar closing near its low, but not all that strong. It traded below 2, and after 1 and 2, it's probably good enough for a second leg up, so I'd rather not sell below 3. Bears who do sell below 3 get disappointing follow through on bar 4. If you sell below 3, you wanted a big bear bar closing near its low. You essentially wanted 7 right here, or 16 right here, and you don't get it on 4. Those traders knew they probably weren't going to get it, but they sold just in case they did. And a lot of those traders exit disappointed around break even during 5. And that's what causes the rally on 5. And anyone who's still short, you can see, is still exiting around that price point during 6. These are really important. These 3 doji bars are really important. It greatly increases the odds of a trading range day to day when you get a lot of dojis in the beginning of the day. You can see we didn't really get any dojis here yesterday, and then we got a big sell-off. And so you could think that 7 today looks kind of similar, but the reality is it's very different because 4 to 6 is dojis, and that means that it's probably going to be a trading range day. And then you get bar 7, and it closes near its low. Bar 7 is important. Remember how I talked about yesterday? The bulls who bought below here, they were never able to get out around break even, or at break even. It never pulled back to below this one low. But you can see that here, if you sold the close of 7, what happened? It pulled back to the one low. So bulls bought below 1 as 7 traded down. And we got a bounce during 8, and that let those traders out at break even. So 8 and 9 are allowing bulls out at break even. It's probably always in short on the close of 7, but 8 and 9 letting bulls out at break even is a problem. It tells you that while this should get a second leg, which it did, the second leg is probably going to be minor, and it's probably going to be a trading range. And you can see 10 trades down, but anyone who sold down here is disappointed in the rally on 9, and so they're getting out at break even. And we get some follow through for the bears on 11 and 12, but now you're selling, low. Bulls have bought here, right here. They bought here. They bought in the same area over here. And this is 1 push down, 2 pushes down, 3 pushes down. So if you're selling down here, you're selling a third push in what is probably a trading range, and you don't want to sell a third leg in a trading range. It's a bad idea. You don't want to sell a third leg at the bottom of a trading range, similarly to how you do not want to buy a third leg at the top of the trading range. It's just not a good idea. Big bull bar on 13, bull surprise for sure, but this channel was pretty tight, so it's probably going to get a second leg down. It might not, but it probably will, which is one of the reasons why the follow through on 15 is not all that good. We might just be testing the 6th low where traders got trapped, or 14, not all that good. We're testing the 6th low. And then again, bad follow through on 15. It seems like bulls scalped out. I think they were able to make about 5 points. What's the high of this? 67.75, which means it needs to go to 73.25. Oh yeah, they made 5 points. So bulls scalped out with a little more than 5 points, and that's what ended up happening up here. Similarly, a lot of bulls are disappointed in how this looked, and they'll start selling out around break even, and they'll, if it races up, they'll buy it back. But we got a giant bear bar on 16. Another reason why the bear bar on 16 happens is because traders who sold above 12 should be able to get out at break even. It's a trading range day, and when traders are trapped on a trading range day, those traders are going to be able to get out at break even. So anyone who sold above 12, which is a reasonable thing to do, disappointed 13, 14, 15, knows that we're probably going to get back to the 12 high. And that's one of the reasons why 16 got vacuumed down. However, bulls know that we should test the 12 high. And so bulls will buy at the 16 high, hoping that we're just going to touch it quickly and bounce and form some sort of rally because of how strong 13 to 15 was. So a lot of traders will buy this high, hoping that we're going to just basically get a big tail on the bottom of 16 and start to race up. But 16 closed really strong. That's not what bulls wanted it or were expecting. So when 16 closes really strong, what do the traders who bought one tick above 12 do? They try to get out of break even. And that's exactly what happened on 17. You can see the high of 17 is one tick above the high of 12. And so the traders who were buying here were disappointed in how strong this was, and they get out at break even here. And that's the cause of the selling here. However, 17 is a poor low one. I don't really want to sell below 17. It's still the bottom of a trading range. And technically the buy above 13 is still on. So bulls who bought above 13 are still holding their longs. So it's not really that bearish. And that's why there are buyers below there on 18. Additionally, if you sold to close at 12, how disappointed are you in 13, 14, and 15? That's worst case. 13 is literally the worst case if you bought above 12, or if you sold to close at 12. 13 is the last possible bar you wanted to see. And so anyone who sold here and scaled in is getting out with a small loss, and they're starting to drive the market higher because every time it gets close to their entry price, they're buying back their shorts, thinking that that's a great deal. I'm glad I got out to break even. So that's why you get a big tail on 18 and a big tail on 19. 19, you got a trend line break. So you have a trend line break on 13, 14, and 15, a pullback and a higher low. So a potential major trend reversal on 18 and 19. It doesn't quite close strong. So it's not the best buy probably above 19, but you still can take it and you get some follow through on 20. Note also the 15 low, right? So the traders who sold above here should be able to get out at break even, same way that the traders who bought below 15 should be able to get out at break even. So we're probably at least getting back to here. I was concerned for the bulls that we might find sellers at the 15 low once we get there, since 16 was so disappointing. However, you have to keep in mind there's a 90% chance we're going to break out of the 18 bar range once it's formed. And so we formed the 18 bar range. And so when you're looking at 21, it's probably always in long at the close of 20 or 21. Or let's just go to 20 because we haven't touched the 15 low yet. So it's probably always in long on the close of 20. There might be sellers here, but it's a magnet, so that we're probably going to get at least here. And if we get here, there's 90% chance we're going here or here. And with 4 or 5 straight bull bars, once you're here, I think it's more likely that we're going to break out to the upside than to the downside. And when there wasn't immediately selling at the 15 low, we got the close on 21. You can see bulls just bought the market. Bulls bought the market on 22, knowing that 1, 2, 3, 4, 5 bull bars is strong enough for a second leg, even if we go down. And so if we do go down, we're going to get a second leg up, and we're probably going to end up breaking out of this 18 bar range to the upside. So that's why bulls are buying the market on 23 or on 22. Bear reversal bar on 23. Some bulls might exit below, but with this being as strong as it is, you don't have to. And you can see bulls bought the close, didn't even let it trigger, and we tested back up to the high. Anyone who bought above 22 knows it's a low probability trade, and they'll probably have to sit through a pullback before they get their swing up. But it's a reasonable buy. Even though, the problem with it is it's climactic, probably a parabolic wedge on a smaller time frame at the top of the trading range. But you still, again, if you're buying this close, 90% chance we're breaking out of the 18 bar range. So probably okay to be long. We get an inside pattern at 24 and 25. By the way, some bulls who bought above 22, disappointed 23, get out at break even during 24, which is what causes 25 to sell off. But you get an inside bar at 25. And if you think about it, we haven't traded below another bar since bar 18, essentially. So we have 6, 7 bull bar micro channel, 7 bull bar micro channel, and it's an inside pattern. And the first breakout is 50-50 chance it fails in an inside pattern. And it's a 7 bull bar micro channel, and there's a 90% chance we're breaking out of the range, and it's more likely we're going here since we're a lot closer. So very likely there are more buyers below 25 than sellers. So you could buy below 25 if you're looking for a way to get long. Follow through on 26, not all that great. Some bulls will buy below and just scalp out, take the quick scalp. Other bulls will hold for the swing, hoping we get up here. 27 tried to break out to the downside, but probably too many buyers below here. Bulls wanted to prevent a strong close and hope that we continue up. And when in, any bear who was front running this, hoping we were going to get a strong close, is disappointed that 27 got bought up, and they'll buy back their shorts at the market, and that's what causes such a big rally on 28, and you get the breakout of the 18 bar range. So I was on bar 28. I wanted to go over something as well. Coming into the day, you should have a mental bias as to what is probably going to happen, just based on the daily chart, what you think the next bar is going to look like. And I mentioned this in the close of yesterday's review, but I mentioned that bulls who buy below October 2nd are probably disappointed in October 3rd, but they're probably going to be able to get out at break even. So I thought we were going to get back to this low, and that low is Monday's low. So it's right here. And I thought we were going to get up there. And so that was another reason why I wanted to buy. And that was my profit target. When I bought a little later in the day during that second leg, I was immediately looking for us to get here because I thought that was likely. And, once we race through it, the leg 2 measured move becomes the next profit target. So it's important to come into the day looking, with profit targets in mind and with a bias as to what you think might happen that day. Because magnets on the daily chart are important and they can affect how the 5-minute chart moves. So follow through on 30 for the bulls. It's an inside bar. It's a couple good bull bars. We're probably going at least a little bit higher. So 29, 30, good follow through for the bulls. Outside down on 31, which is disappointing. I think it's okay to exit below 31. That's a stronger close than you want if you're a bull. And occasionally it might sell off to the moving average. Bad follow through for the bears on 32, which isn't surprising with how strong 20, 28, 29, and 30 are. 33, it's a double top, but not all that strong. To me, it looks like we tried to rally back to the 30 close, and a lot of the bulls sold out of their longs, disappointed. 34, it's a bull bar closing near its high, and it's a good, reasonable buy. Always in bulls who exit below here might buy again above here. But you have to keep in mind that even though we traded above the 2 high, that bears who sold above that 2 high and sold more higher were able to make money. So you do not have an open gap. You do have an open gap with the 27 high and the 29 low. So any bears who sold above 27, disappointed 28, never able to get out at break even. So you have some trap traders, but for the most part, traders are able to get out at break even on their first entry, with profit on their second entry for the bears. So, that's one of the reasons to be cautious buying up here. Just thinking logically, if bears made money selling go up here, they're probably going to sell again at the higher price, thinking if they made money at selling at the lower price, they're probably going to make money scaling it at the higher price. So bears know if they sell above the breakout on 31, they're probably going to be able to scale in and make money. And, that's exactly one of the reasons why 35 is a strong bear bar closing near its low. It's a wedge double top at 35. It's a pretty tight bull channel, so I wouldn't sell below 35. But if you're long, I would exit below 35. But you can see bulls bought the close at 35, hoping that it wasn't going to trigger, and that's what causes a big bull bar on 36, the inside bar. You get follow through on 37, but ultimately too many sellers up here. Bulls taking profits, bears establishing some shorts, knowing that they're going to be able to scale on higher and make money. That's what causes 38 disappointment, 39 disappointment. If you're disappointed in 38 and 39, when you get 40, pretend you bought the close at 37, because it's not a good buy the close bar, but it is reasonable after 36. Disappointed 38, 39, you're going to try and get out around break even on 40. 41, it's a wedge. So we have a spike and a channel. Again, it's a channel within the wedge. So it's something of a nested wedge, 1, 2, 3. And then you have the smaller one, 1, 2, 3. The important thing to know is that you need to get out, below 41. Some bears who sold the close of 39, disappointed at 40, are buying back shorts on around their break-even price, and that's kind of what causes the tail on 41. But it's not a big enough tail, and you need to get out below 41. Your premise isn't really valid anymore. I mean, if you're buying up here, you're hoping it's a bull trend and we're going to continue. But if you bought the close of 30, you're 11 bars later and you're at a loss. Does that sound like a bull trend? That's not what trends do. This is what trends do. You could have sold here, 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 here. Where are you 10 bars later for all these? You're somewhere down here. You're making money. So that's what trends do. This is not what trends do. They don't go sideways for 10 bars. They sometimes have pullbacks like this, but you have to be expecting pullbacks in trends. And that's another reason why if you're long in here, you get out below here. If it is still a trend, it's going to give you another chance to probably buy lower. And you're expecting a second leg from the tight channel. Bad follow through for the bears on 42 and a better bar on 43. It's pretty clearly always in short, I would say, on the close of 43. Probably at least another leg down. And we're probably going to test the 27 high, since traders who sold there should be able to get out at break even. Just checking something. Okay. 44, bull bar closing near its high, but really probably just trying to test the 40 low, trying to create some sort of wedge, but this channel is too tight to want to buy 44. And even if 46, so 45, second leg down from this, bears who sold this close disappointed that, trying to get out at break even during 45, which is why 46 ended up being a bull bar. But even if 46 closed on its high, this channel is too tight. I want a deeper pullback before buying. So that's why there are no buyers above 46. That, and it's not a good close. And so you get outside down 47, follow through on 48. First reversal up 49. It's a wedge bottom, but this is way too tight to want to buy. I would rather wait. And that's one of the reasons why you get bad follow through on 50, 51, 52, and then you get a big sell off 53. Bulls trying to drive the market up, too many tails, and it really just ends up being 4 doji bars. So not surprised we get a big bar on 53 or 50, follow through on 54. Reversal up 55, but again, it's a high 4, but this channel is too tight. When the channel is really tight, you do not want to trade against it until you have a trend line break. And if this is your trend line, you get the trend line break on 57 and 58. If 57 closes on its high, it's an inside bar, and it's maybe a reasonable buy. But I don't think it's all that great because of how tight the channel is. And that's one of the reasons why once you get follow through on 58, traders sell immediately. Traders who buy above 57 just scalp out quickly. And, 58 might be a vacuum test of the 52 close. You have 4 straight bull closes. They're dojis, but they're bull closes. So anyone buying over here is disappointed in this or this, and they're getting out around break even. And that's also what 61 tested, right? Some traders took the small loss and, that causes 59. Others didn't, and they got out during 61. But 60 is after a trend line break and a retest. And so I think 60 is a reasonable swing buy, but, it didn't race up immediately. It kind of hovered around here. And so a lot of traders will exit. And then you get a bear bar closing near its low on 61. And so if you're long above 60, kind of a tough call on 61. I think it's okay to just exit below 61 because if you get a bull bar closing near its high on 62, you can just buy back your long. All you can see at this time, obviously, is this. And so I think it's okay to get out here because sometimes this is going to trade down here, and I'd rather take a small loss here than risk taking a big hit versus I know if I get a bull bar closing near its high, I can just buy again somewhere up here. And so I'm only going to miss out on a point or two of the potential profit while getting rid of the risk of like 5+ points. So that's a good trade. It's a good exit. And then you can buy again above 62, and that's what a lot of traders did. And that's why you get followed through on 63. Another way to get long is buy where weak stops are. It's not a good trade below 61. It's probably the bottom of a trading range after a trend line break in the tight channel. But weak bears will sell below 61, hoping that it's a low one and the bear trend is going to continue, not realizing that the trend line is broken and we're probably going up now. And so some traders with their, the weak bear stops are here. You can buy above this extreme. Some weak bears will sell below 2. You can buy above this extreme. You can buy above this extreme. So you can buy above all the pullback extremes because that's where weak bear stops are. So 63 followed through for the bulls. Disappointment on 64, but it's probably because we're just testing the 46 low where bulls got trapped. This is probably more bull selling than anything. Bad follow through on 65 for bulls who sold below 64, or for bears sold below 64. So a lot of them, any bear sold below 64 is buying back their shorts at break even on 66. You can see it touched their break even price and they immediately bought back shorts, driving the market higher. And at this point, you got to be wondering if we're going to get a buy the close rally. And that Monday's low is a magnet that we haven't tested yet, and it's a potential leg 2 measured move. So it's better to just establish a long position. And if you get a bear bar closing near its low, you start to see this, and it's good to be long. But if you get a bear bar closing near its low, you can just get out. And you can see we kept rallying, and we never got that bear bar. So, good bull bar, 68. It's potentially a third push up, but still okay to be long. Follow through on 69, 70, 71, breakout to a new high on the day. And then, we ended up touching that low and we reversed around the leg 2 measured move. And you do get by the close rallies. They're relatively common, or not super common, but they happen. It's just, that was the day basically. On the daily chart, it's an inside bar. I think, some swing bulls will buy above this. The problem with this is it's a tight channel. It was the same problem we were talking about on the 5-minute chart. So this is a pretty tight channel down. And so, the first reversal up is likely going to be minor. It'll probably bounce to maybe the moving average. So if we start to rally tomorrow above today's high, I don't think it's super likely. Maybe 40% chance we get a big bull trend day tomorrow. But if we start to rally, you have to be aware of the daily chart and the fact that we could just get a rally back up to this low, this August 18th low. So, yeah,